Greetings and welcome everyone to this special Macro Hive webinar. My name's Bilal Hafeez and I'm the CEO and Head of Research at Macro Hive. For people who don't know me, before I founded Macro Hive along with a few others back in 2019, I used to run various research groups at various banks, starting at JP Morgan in the late 1990s, then Deutsche Bank in the 2000s and 2010s, and then Nomura in the late 2010s. And during my time at all of these banks, I ran various groups ranging from foreign exchange research, rates research, multi-asset research. So covered all the main markets that you can imagine. And as for Macro Hive is perhaps one of the leading independent research providers to institutional investors around the world, and also to retail investors as well. So do check out our website if you do want more details. Now, as for this webinar, this is a special webinar that we dedicated to family offices. So the topics here we think are very relevant to any family offices around the world. We're going to talk about big picture macro, what the Fed's likely to do. Then we're going to dial into and zoom into some of the assets that family offices seem particularly focused on, including private markets and then also real estate too. And we'll also talk about what our intelligence tells us that other family offices are starting to do in this type of environment. I have a great set of speakers today. We have Dominique Dwor-Frecaut, who is one of the top economists in the world, and she's going to talk about the latest happenings in the US around the bank crisis and also her Fed view, which is very non-consensus. For people who don't know Dominique, she used to work for Bridgewater, the IMF, and the Fed, so she has a very impressive background. We also have Samarjit Shankar, who will talk about trends in asset allocation and amongst family offices as well. He has an equally impressive history as well. He's worked at some of the biggest banks in the world, JP Morgan, Barclays, Bank of New York, Mellon, covering research as well as speaking regularly with some of the largest institutional investors in the world too. Now, before we go into the meat of the webinar, I would like to hand over to my partner at Macro Hive, Andrew Simon, who will talk about our new initiative on family offices. So over to Andrew.
Hi, everyone. And first, to echo Bilal's comments, we really appreciate people dialing in, all the amazing support we've had over the last kind of 3 to 4 years since building Macro Hive. 2 seconds on my background. So I've always initially, been in work for several of the biggest banks, including Deutsche Bank and JP Morgan, either running derivative trading businesses or sales businesses. This is in US and Europe. I also led several businesses focused on tail risk hedging, which of course is extremely important in this environment. And I also had a hedge fund in the US for several years. As it pertains to this webinar, so I just wanted to give 2 seconds, some of the background on this. The idea is this webinar is a prelude to our family office and private wealth offering, which we will be releasing in the next few months. Right now, starting next week, we'll be collating an invite-only waiting list to potentially join that group. The initial launch will be to a limited number of clients. And we're just doing that particularly because we want to create this collaborative, kind of transparent environment where not just that we're giving our insights on what people should be thinking about, how to be positioned, how to protect, how to structure, but also create the kind of environment where our clients themselves feel comfortable kind of sharing concerns, views, opportunities, and building on that over the next several years. The product itself, just high level, will include access to targeted parts of our research that are really relevant for family offices, interactive webinars, access directly to our top researchers like Dominique and Samarjit, macro and investing themed dinners. This will be US, Europe, and Asia. And over time, curated kind of deal sharing as well. There'll be more details in what the offering will be in a follow-up email that'll come out early next week. And through that email, please initiate your interest in potentially being part of what we're looking to create in the space. And obviously, if anyone has any questions, you can always email me, andrew.simon@macrohive.com. You can also ping me on Bloomberg if you're on Bloomberg. And I'm happy to get on a Zoom, answer anything over email. And yeah, and hope, we're super excited about this offering. We've been able to build an amazing brand with the institutional space, and we really want to bring that knowledge and expand that into really helping family offices in the best possible way we can. So on that, I guess, Bilal, I'll kind of hand it back to you.
Great. Thanks, Andrew. Yeah, it's a very exciting product development that we're doing here. So do reach out to us to get more details of that. So as Andrew said, you'll get an email next week, but equally just email Andrew or contact myself if you want to get more details. Now, we're going to start now with Dominique, who will give her take on some of the things that's been happening over the past few days, over the past week, and also her take on the Fed. We have a Fed meeting, obviously, next week as well. So Dominique, can you switch on your camera and mic, and then we can get going? Yeah, so let me hand over to Dominique, who'll give her view, and then we'll come back to me where I'll talk about private markets. So over to Dominique.
Thanks, Bilal. Hi, everybody, and thank you very much for joining in today. So I'm going to explain why I've had a view of 8% for the terminal Fed funds rate for about a year now, and how it has been changed by recent developments. So the reason for the 8% call haven't changed. It's basically the Taylor rule. The Taylor rule, it's it's an interest rate setting rule that says the interest rate that stabilizes the US economy is a weighted average of the deviation of inflation and unemployment from their long-term levels. And there is a really good fit between the Taylor rule and what the Fed actually does. Since the 1970s, each time the Fed has started to tighten was when there was a big gap between the actual Fed funds and the Taylor rule Fed funds. And the tightening cycles typically have ended when the gap was closed or was very small. And my super simple estimate of the Taylor rule at the moment is about 8%. Now, models in general have to be taken seriously, but not literally. Who knows whether the terminal rate will end up being 7, 8, or 9%, but it will end up being much higher than what it is now. So the first reason was the Taylor rule. The second reason was that a year ago, inflation already had acquired a lot of inertia. In particular, there was a feedback loop between wages and prices that had become established. And when that happens, it's very difficult to bring down inflation without a recession, because the recession is what gets both workers and businesses to demand lower prices. And to get a recession, we need a much more aggressive Fed policy. And the third reason was the Fed game plan. The initial game plan was to declare inflation to be transitory and hope for the best. That didn't work. So now the Fed is data dependent, which means it is reactive to inflation prints. And again, the historical record shows that when the Fed waits for inflation to be well outside of its target, it's much more painful and it takes greater tightening to bring it back to target. So these were my three initial reasons. And up to the SVB bankruptcy, I was feeling rather good with the view because, hey, growth was accelerating, residential prices were stabilizing, things were going my way. So how does the SVB change the view? Not much, actually. In the short run, I'm thinking there is a good chance that the Fed will pause, simply because if the Fed hikes in the middle of bank rescues, and as we speak, it seems that First Republic is also going to get rescued, it could just tighten funding conditions and add to the loss of confidence. So I'm actually thinking that there's a good chance the Fed does nothing next week while claiming that financial stability consideration will not constrain monetary policy in the longer run. But beyond next week, I think there is a good chance the Fed will keep hiking as I expect, simply because what we are dealing with at the moment is not really a systemic solvency crisis. What we are dealing with is a confidence/liquidity crisis. And I like the Fed policy response. The new facility to fund banks will prevent banks from going through the same things that SVB went, basically an outflow of deposits, forcing a fire sale of the bond portfolio and bringing about insolvency. The Fed facility will allow banks to get funding without any haircuts on the collateral, which is unprecedented for a central bank. It is really an extraordinary measure. So the banks are protected from unrealized losses on their bond portfolio, precipitating a bankruptcy. Also, the guarantee of the making whole of depositors, irrespective of the size of their deposits, is a very important confidence building measure. So I am confident that the Fed is going to contain this crisis. There is a risk that we could have a bit of a credit crunch. For instance, banks are likely to tighten standards, having gone through these pretty shocking and traumatizing events. Also, if regional banks got merged with the Big Four, we could have a decrease in the supply of credit, and that would be negative for the economy. But it's not my base case scenario, because I think there will be a strong policy response. And so I'm sticking for now to my 8% call, though in the short run, maybe over the next couple of meetings, the Fed is going to be more cautious, maybe do nothing next meeting. What happens next depends on whether the market has stabilized, but the market and the banking system will be stabilized. And once that happens, inflation prospects won't have changed much. Growth prospects won't have changed much. So we will be back, in my view, on the trajectory towards 8%. So that's my story.
Great, thanks a lot, Dominique. And there's a Q&A button at the bottom of the Zoom window. Do start posting questions. After our speaking segments, we'll then take and answer all of the questions. So thank you, Dominique. So now what I'll do is I'll start to talk about some of the implications for family offices. And the first thing I would say is that my views in terms of asset allocation for family offices and in general for asset allocation is not entirely dependent on the Fed raising rates to 8%, but it is dependent on the fact that central banks will keep rates higher for longer than most people expect, because we're in a fundamentally different regime of higher inflation. So unlike the previous 20 to 25 years when central banks could always cut rates because there was no cost, there was no inflation cost, today they have a constraint, which is very, very different. It's much more similar to what we saw in the 60s and the 70s, where central banks were constrained in different ways. Now, in terms of what assets I wanted to talk about specifically, it was actually private markets and then real estate, because I noticed when I speak to family offices seem to love getting involved in private equity, private deals, and then also real estate as well. And I have a lot of concerns right now about private markets in this stage of the cycle. And just to reinforce all of these points, I've got some slides, and let me just share some of the slides here. Now, the first thing I just wanted to make a point of is that since the global financial crisis, in 2008, what's been interesting is that bank balance sheets have increased, but what's increased more has been shadow banks, what we call non-bank financial institutions. So these are entities in the financial system that can lend, but are not regulated banks. So this, for example, could be an asset management company that basically buys a corporate bond. And so by buying a corporate bond, they're lending to a company. Or it could be a private credit transaction where there's a private debt deal between an investor where they buy a loan to the middle market, say. So what's happened since the global financial crisis is that because of regulation, banks have been a lot more conservative, but shadow banks have really taken up the slack. And this is one of the reasons why I think that the bank issues that we've seen over the past week aren't necessarily as serious as the global financial crisis, because a lot of the more kind of reckless behavior, more of the asset price overvaluations have really been more on the non-bank side than the bank side. And that's where I think the bigger risks lie. So within the shadow system, so to speak, what we find is the largest players are investment funds, so fixed income managers, pension funds, insurance companies, broker dealers, and so on, and structured finance vehicles. So this is really the less regulated parts of credit intermediation in the system. And a big part of this is private markets and private equity. So this what this chart here shows you is the amount of private capital that has been raised over the last 5-6 years. And what you can see is that since 2017, every single year, over $1 trillion of private capital has been raised. And it peaked at around 1.2 trillion in 2021. Last year, we estimate around 1 trillion, just under $1 trillion was raised that went into private markets. And within private markets, the biggest segment are buyouts, so the conventional private equity. And then it's the real estate and venture are the other sort of big segments. So this, I think, is where a lot of the risk is in the system. And I think this is a segment where I think that the higher rates environment that we're in is going to pressure these sectors more and more and more. And for me, looking back now, it's no coincidence that it was Silicon Valley Bank that went down, because they were the ones that were highly levered, or their deposit base was very concentrated towards VC and startups. And that's where the leverage is. That's where the overvaluations are. And so anything that touches these overvalued assets, hyped up sectors, those are the areas of the financial system that will come under most pressure. Now, why do I think that, apart from higher interest rates, which I think really fundamentally affect the valuations of startups, PE companies that have been bought, what's interesting is that if you look at the exits of private equity portfolio companies, what you find is that last year, private equity companies were struggling to exit into public markets. There was barely any deals of exits into public markets. Instead, most exits for private equity firms of their portfolio companies were to either strategic buyers or to other private equity funds. And that, to me, tells me that there's poor liquidity, you could say, and there's a disagreement about the valuations that private equity companies have on the companies on their portfolio. Not only that, but if you look at paid-in capital, so what you're seeing is that the amount of money that has yet to be deployed is quite large. So people talk about cash on the sidelines in private markets being a positive, but I view it as a negative because this tells you that private companies are struggling to find attractive investments for them to deploy the capital in. So capital that was raised in 2021, only 28% has been deployed. And from 2020, it's only 43%. And so what happens is if you're a family office and you've made a commitment to a private fund, in essence, you're offering them a 0% loan, and they're not doing anything with that. But there is a larger issue as well, which is that even with their capital, because interest rates have gone up, and if you look at the leverage interest rate, it's gone up sharply, the ability to lever up the capital is also going to be much more challenging going forward as well. So in my view, the underlying fundamentals of private markets is showing clear signs of distress in the sense that it's harder to exit into public markets. You're seeing less ability for private companies to deploy their cash because they can't find attractive investments, and their funding costs are going up quite dramatically. But the bigger issue for me really is one of performance. If I look at the performance of private equity funds, so if you're an LP, so your family office, your limited partner, and you've invested in a fund, since the global financial crisis up until last year, the returns of PE for LPs was pretty much the same as investing in stock markets, in public markets, say the NASDAQ or the S&P 500. There was barely any outperformance over that period of time. Now, before the global financial crisis, PE firms were regularly outperforming public markets. But since the global financial crisis, what's happened is that the returns have collapsed. There's no evidence that there's systematic positive excess returns of private equity over public markets. The only time where you've seen a clear difference is last year. Now, last year, private equity companies claim that their portfolio companies did not go down in valuation that much, a couple of percent or so, when stocks were down 20%. Now, in my view, that's a mark-to-market issue. It's not a true reflection of true valuation. And these are the types of markets we're in today, where people are very skeptical of assets that are not marked to market. We've seen that with banks already. If things aren't marked to market, it's challenged. And I think something similar will start to happen to private equity markets as well. So the other issue is that private equity companies don't necessarily deliver stellar returns relative to public markets. However, the part of private equity that is doing well are the GPs, the general partners. So if you look at the performance of the equities of the largest private equity firms in the US, they've massively outperformed the S&P 500. So PE firms, the profitability, the growth of the assets, the inflows into private equity have been so strong that private equity firms themselves have become very, very profitable. And they've been this massive winner over the last 5 to 10 years, since 2017. Remember, 2017 was the period where you started to see $1 trillion a year go into private markets. And so they've been the big winners out of all of this. And in some ways, what's happening in the private equity space is that they're moving to a model away from delivering high returns for their clients. And instead, they're moving to a model of asset gathering, where they can earn higher fees on asset gathering. And as a result, the GPs are doing very well. So if you do want exposure to private equity, rather than investing in a fund of a private equity firm, it's better to invest in the private equity company themselves, buy shares in the private equity, so you can capture some of the returns they're making from asset gathering. So very skeptical, as you can see, I'm a very sort of skeptical take on private markets. And I think the high rates environment in particular is going to be very detrimental. If we kind of step back and become a bit more technical, what seems to have happened over the last 10, 15 years is that we've developed a duration bubble, which means that over the last 10 to 15 years, because interest rates have been very low and the Fed's been doing QE, what's happened is that entities or companies that have very long time horizons before they can deliver some returns have been attractively valued. Because interest rates are zero, the present value of those cash flows become attractive. But when interest rates go up, then suddenly you put a much higher premium on immediate cash flows and profitability. The cost or the penalty of further out profits becomes very high. And then that's what we're in, an environment where duration is shortening massively. And so you ideally want to be short duration, not long duration in this type of environment. And private equity inherently is a long duration asset class. Today, the premium is on having cash at hand. It's on having liquidity at hand. And those are the types of assets that will perform very well. Now, a second and a side note now on real estate. Real estate, again, is a very interest rate sensitive market. If we look at US commercial real estate, you can see that it had great returns just after COVID. There was a big bounce. But recently, we're now starting to see negative year-on-year price changes in commercial real estate. So a bit of a mini bubble started to emerge just after COVID. And now we're starting to see the bursting of the bubble. The other challenge today is that the CRE market, the commercial real estate market, liquidity is very, very poor. So it's actually hard to get accurate price information because not much is moving. On the credit side, and this is where the banking crisis we're seeing today could come back to hit this, is that loan demand and loan supply is collapsing. So this is a chart of a survey, the Loan Officer Survey, which shows how much loan demand there is for commercial type real estate, and it's collapsing to the height of COVID levels. And now, from what we're seeing in this banking crisis issues, banks will be much more reluctant also to lend into real estate as well. So real estate, I think, is also under considerable pressure too. So given all of this, my overall stance is to avoid private markets as much as you can, avoid real estate as much as you can, put as much of a weighting into cash. It's not so exciting, but yields are picking up. Cash gives you optionality as well in terms of liquidity. Cash outperformed almost every asset class in the 1970s too. So I'd be long cash. I'd find ways of being long inflation, so long inflation swaps, for example. I'd also position for lower long-term real yields as well in this environment. So there's all sorts of different ways you can position in this type of environment, but ultimately it's more about being defensive than it is about being aggressive. So those are some of my thoughts on some of the asset classes which I think family offices like to invest in, and there tends not to be as much of a balanced view on them. So hopefully I'm correcting some of the narrative there. Now, I'll stop speaking there and I'll hand over now to Samarjit, who will talk a bit more generally about asset allocation trends and then also about what he's been seeing in the family office and endowment space. So over to Samarjit.
Thank you, Bilal. Hello, everybody. I believe asset allocation decision-making is at a very interesting juncture as we speak. Firstly, public equities are vulnerable given concerns about recession and earnings downgrades, which I believe are imminent. And we're likely going to start seeing that in the first and second quarter earning reports. In private equities, as Bilal quite eloquently presented, we are increasingly concerned about diminishing returns, markdowns, and potential capital calls. Meanwhile, in the fixed income space, US Treasury yields have risen to attractive levels over the past year. And if you would take a step back to 2022, it was a very challenging year for investors in general. Stock bond correlations turned positive, and as a result of which all major classes sold off. And there was almost nowhere to run, and people were investors were getting out of their allocations and pulling into cash. This also led to a greater interest in diversifying strategies, especially alternatives. But as we speak, and if you look at the past few weeks, and especially the past week, we are starting to see some pretty strong safe haven flows getting back into the US Treasury market. And the estimates of the terminal rate are ranging from 5%, 6%. Dominique talked about 8%. Irrespective of what your view is, I believe that the Fed will start slowing the pace of rate hikes, given the recent financial stability crisis. But all said and done, we are nearing or approaching the end of the hiking cycle. And I think if you look at a 3 to 5 year perspective, this does suggest that we might be reaching an inflection point in the stock bond correlations, which essentially means that bonds might once again start providing ballast to the traditional 60-40 or 50-30-20 portfolios. And in this environment, if you look at equities versus bonds, I would say this is a good time to actually take profits and take some exposure off of the riskier equity asset class and get into cash primarily, keep your powder dry. But also, if you have a 3 to 5 year perspective, look into longer dated US Treasuries, because that is an area, that is a part of the curve that is unlikely to go much higher in terms of yields and provides a good safe haven holding, core holding in your portfolios if you have to maintain fixed income exposure. In general, I see a higher volatility regime in place over the next few weeks and months. And as a result, I expect cross correlations amongst the riskier asset classes to grow, to rise. So which essentially means equities, credit, high yield, and risky assets in general. Against this backdrop, diversification becomes even more important. And I look at diversification in two ways. One is geographical diversification. There's been a lot of focus on the developed markets, and the US market has been the key engine of investment portfolios, as has the US economy being a key engine of global growth. But as we're seeing these strains emerging in the U.S. economy and the technology-driven runs on banks and contagion risks, I believe it's a good time to also look at geographical diversification. We do have India as a pretty strong and sustained. We're seeing sustained and strong economic growth in India. We're also seeing a nascent post-COVID recovery in China, and I think that has some legs, given the very strong support from the government and the central bank there. So I think it's time to kind of look outside the US in terms of some strong pockets of growth in the emerging markets. I also see in the alternative space, which has been a staple for some family offices, there should be a greater focus on relative value plays rather than directional plays. If you're going to look at hedge funds, I believe this is a good time to look at relative value, because when there are crises, asset prices tend to overshoot. They provide very good opportunities. So if you have a relative value opportunity, that's much more preferable to taking directional bets, because if you look at directional bets, there's a lot of volatility and there's a lot of uncertainty as we speak. And also, I would look at more discerning allocation in the PE and the VC space. There is some money being taken off the table. And I think family offices are being more circumspect in future allocations as we speak. So long story short, in sum, I'd say in this environment, safe haven US Treasuries, if you want to hold a fixed income allocation, cash, take some money off the table on the equity side. And once the market cycle starts to stabilize and there's more certainty about Fed policy, I would look at value equities as a good place to start applying some of the cash back into asset classes. If you look at the overall family office trends that we have been observing, I see a continued interest in sustainable and impact investing. I also see the interest in private equities and alternatives being a lot more focused and discerning as we speak. And a lot of focus has now been on liquidity needs, wealth preservation, defensive allocations, and a lot more money being taken off the table and parking in cash. I mean, if you look at some of the very common retail products, even an 11-month CD from your usual bank is providing you a 5% return. And yes, it's barely keeping up pace with inflation. But as inflation tops out, and as the rate hike cycle approaches the top of the cycle, I think those yields are very good to lock in. But overall, I think this is a good time to kind of be defensive. That's it for me.
Great. Thank you very much, Samarjit. Now we've got a whole ton of questions coming through. So let's just go through some of them. Okay, Dominique, there's a couple of questions for you. Okay, the first one from Jean-Philippe. It seems the economy can handle higher rates, but not the banking sector, which might take the economy down given recent bank failures. Reserves at small and medium-sized banks are very low levels, suggesting higher rates will tip them over into a liquidity crisis. Dominique, what do you think about this?
This is a great question. I think there is an issue with regional banks and more broadly with banks. But in the short term, I think Jean-Philippe is spot on. There is an issue with the business model of regional bank. And it comes largely from the difference in funding costs, especially after the SVB bankruptcy. If regional banks want to keep their deposit base, they're going to have to raise the interest rates they pay depositors and probably raise them to levels that make their business model unprofitable. So I suspect I'm not the only person in the US to think so. I think the US Treasury, the Fed are very aware of the issue, and I expect them to take measures to support regional banks, because if regional banks disappear, we could have a credit crunch issue. And one such measure could be to guarantee fully all deposits, irrespective of size, which is what is already happening in practice. So it's not so far-fetched. And one piece of news which is very intriguing this morning is that so the regulators are working with First Republic to shore it up. And they are not, it looks like they are not taking the traditional merger route, but instead are arranging for the big four banks to lend some deposits to First Republic. So it looks to me like there is a very strong intent on the part of regulators to make sure that regional banks survive this crisis. So
no, I think that's sufficient. Yeah. I think that's good. We've got lots of questions. So there's another question. Maybe this is more for Samarjit. Will higher rates push investors back into bonds and out of private assets? I think you kind of answered this already, but
yeah, I think I alluded to that, and I think the answer overall is yes. It all depends on the assessment of risk, and I think the safer haven treasury holdings. And if you look at overseas, the German bonds would be areas to kind of park your money in if you want to take some money out of private assets. And if you don't want to sit in cash, if you have some fixed income allocation to fulfill, that's the place to be. Yes.
Yeah. And there's another question. Maybe I'll answer it first, and then Samarjit, you could follow up if needed. Why are equities so resilient right now? In my view, I think what's happening is that this past week, what reveals is that equity markets are essentially saying that the banking crisis is actually not that bad, but because the interest rates are falling, essentially. So ironically, it tells you how sensitive equity markets are to interest rates, that anything, whatever the reason is, if the Fed stops hiking, then equity view that as very, very positive. So number one, I think equity markets are essentially saying that this is not a full-on banking crisis and it's not a repeat of GFC. Number two, equity markets are responding to the fact that markets are pricing out the Fed. And so the Fed is, barely priced for a hike next week, and then after that's cuts thereafter. So which equity markets are taking as very, very positive. Samarjit, anything you want to add to what I just said? Or
I would agree with what you said, Bilal. I think the assessment that the Fed is about to stop raising rates or is coming close to its rate hike cycle is being viewed as a positive by the equity market. But where I think there is some dissonance in terms of what investors are expecting and what the markets will actually most probably do, is that there's going to be a lot of margin pressure. There already is a lot of margin pressure in terms of wage growth and costs. supply side constraints, and that has pushed up the cost structure of most companies. And we're going to start seeing that reflected in the earnings reports starting the first and second quarter, which is imminent. And once that comes through, and there are concerns about recession, and recession risks are priced in higher, you would see a downturn in the equity market. And I think that's where the resilience is about to be coming to an end.
Great. Yeah, agree with that. Dominique, there's a question for you from Emil, who asks, what's the timeline for the Fed going to 8%? And historically, how long does it take for rates to go down to, say, 2 or 3%?
So my timeline is next year. I think this year we could have about another 100 basis points in hikes following a pause. And I think the 8%, the peak rate is next year. And in terms of a timeline for cutting rates, the last time core inflation was at the level where it is now was in 1989. And then it took 6 years for inflation to go back to about 2%. So that's the time frame, I think, for the rate cuts.
I have somebody asking, what do you mean by asset gathering? That was, I guess, a question for me. I talked about how private equity firms, in my view, are shifting towards more of a model of asset gathering rather than returns. So every fund management company, whether it's private markets, public markets, has a choice to expand the assets under management to earn the higher 2% fees, or they can keep their assets smaller in order to make sure they can deliver higher returns for their clients. I mean, the larger you become, the harder it is to find attractive investment opportunities. And what ends up happening is the larger you become, you end up just converging to the market return. There's no way to kind of beat the market anymore because you're just too big. And so my sense is that private firms are now going for the growth side, just growing their assets because that's more profitable for them in the long run. And as a result, it will be harder for them to find attractive investment opportunities going forward. So asset gathering rather than having a business model optimized to find strong, profitable opportunities. There's a few other questions. I'll just take 2 more questions. This is, I guess, for me and Dominique. So Dominique, how would China's reopening contribute to new growth for the US and the global markets, GDP trade? This is from Bobby.
Actually, I'd argue it's more trouble than growth, because a reopening is likely to support higher energy prices. And in the current context, this means inflation moving higher. In terms of incremental demand, the US is very domestic driven, unlike Europe or Japan, for instance. So I don't think the impact would be that great.
Okay, no, that's good. And then there's a question from Shahid who says, if this is a fundamental shift, how long will this transition play out? 1 to 2 years? So I think I opened by saying that there's a fundamental regime shift occurring in markets. Typically, when you look at historical precedents, whether it's the 60s, 70s in the Western economies, whether you look at emerging markets like the LATAM inflation crises that we saw, Eastern European inflation crises, it typically lasts for 5-6 years, if not longer. So it's not a 1-2 year phenomena. It tends to last longer. Underlying that is this notion that inflation, we've gone from this long period of low inflation, and now we're going to have a period of higher inflation. And the trouble is that when you transition from a low inflation regime to high inflation regime, it's very hard for policymakers to do the necessary things to bring inflation down very quickly. And by delaying those actions, you end up sowing the seeds for a longer, more protracted inflation sort of period. And I think that's what's happening right now, where because inflation hasn't been squashed or squeezed out of the system, workers, for example, are feeling emboldened now to demand higher wages. And then that has a knock-on effect. Indexing of like Social Security and those things start to kick in, and it starts to cascade through the system, so it becomes harder and harder to tame inflation. So my view, I think it's more than 1 or 2 years. It's going to last longer. Dominique, do you have a view on this?
Oh, I completely agree, and that's what the record shows. I'm with you on this, Bilal.
Yeah. Okay, there was another question, but I think half of it was chopped off by Bilal, actually. But private equity, the real return actually would be even worse, as most operate in the and ... It's quite an intriguing question. So we'll leave that one for now. I'm not sure what the full question is. So with that, I just wanted to thank everyone for listening to this webinar. And if you are interested in learning more about the research we produce at Macro Hive, do reach out to us. If you're interested in our new family office product, do reach out to us as well. You can email me, bilal@macrohive.com, or email my partner, andrew.simon@macrohive.com. Or you can find us on LinkedIn or Bloomberg as well. So once again, thanks a lot for listening to the webinar, and good luck for the rest of the year. Thanks a lot. Bye.